Have you ever wondered how auditors can sniff out inconsistencies in a company's financial data? The secret lies in a technique called analytical procedures. This is an investigative technique that evaluates financial information by analyzing plausible relationships among both financial and non-financial data. Let's delve a little deeper into this fascinating world of numbers, ratios, and relationships. Analytical procedures are like the Swiss Army knife in an auditor's toolkit. They are used throughout the audit process and serve three primary purposes. The first purpose is the preliminary analytical review, a requirement per the International Standard on Auditing, ISA 315. This review is conducted to understand the business, its environment, and its financial performance relative to prior years and relevant industry comparisons. This helps the auditor assess the risk of material misstatement, which in turn determines the nature, timing, and extent of audit procedures. The second purpose is to use analytical procedures as substantive procedures. This happens when an auditor believes that analytical procedures can be more effective or efficient than tests of details in reducing the risk of material misstatements at the assertion level to an acceptably low level. The third and final purpose is the final analytical review, another requirement per ISA 520. This is an overall review of the financial statements at the end of the audit to assess whether they are consistent with the auditor's understanding of the entity. If any irregularities are found during this review, the auditor should reassess the risk and consider if additional audit procedures are necessary. Now that we understand the purposes, let's explore a few examples of analytical procedures. One common example is comparing the days sales outstanding metric to the amount for prior years. This relationship between receivables and sales should remain about the same over time unless there have been changes in the customer base, the credit policy, or collection practices. This is a form of ratio analysis. Another example is reviewing the current ratio over several reporting periods. This comparison of current assets to current liabilities should be consistent over time unless the entity has altered its policies related to accounts receivable, inventory, or accounts payable. Again, this is a form of ratio analysis. A third example is comparing the ending balances in the compensation expense account for several years. An unusual spike may indicate that fraudulent payments are being made to fake employees through the payroll system. This is a form of trend analysis. So to summarize, analytical procedures are an essential part of the audit process, used for preliminary and final reviews and as substantive procedures. They involve comparing and analyzing financial and non-financial data to identify inconsistencies or irregularities. Remember, just as a Swiss Army knife is useless without the skills to use it, analytical procedures are meaningless without the knowledge to interpret and act on the results. It's not just about crunching numbers, but understanding what those numbers reveal about the business. In the end, it's the sharp mind of an auditor that turns the raw data into valuable insights. And that's the real magic of analytical procedures.